But let's return to the markets and talk about them at large with Alok Agarwal, the fund manager of equities at DHFL Pramerica Asset Management. Thanks, Alok, for joining us here on ET Now. It was a pleasure chatting with you. We're talking on a day where it's the global cues at play, the dictating the cues worldwide, the fight between the United States and China. When it comes to trade, it's not good news for a country like India. It's not good news for emerging markets. Dealers around the world are pressing the sell button. What are guys like you planning to do at times like this?
See, certainly the uncertainty thrown in by the statements by the two of the biggest economies in the world are letting things become a little more uncertain and difficult to predict. The global trade and global GDP was picking up nicely. But initially when the trade war things started up, it seemed that it will fade out after the meetings between the two major economies. But the news front in the last few days are just keeping everybody rattled as to what comes next, because it's not seeming to end here. So what one is waiting for is where does it end and how does it end, so thereafter one can take calls on that.
Okay, but there are other reasons for volatility as well, and what I want to understand is that how are players like you rejigging portfolios, or how are you reacting to all of this? You've got the global volatility. On the other hand, you're looking at a scenario where the markets had given into the fact that Narendra Modi would come back with a simple majority in 2019. The markets now are not so sure of that. So what are managers like you doing at times like this? Is this a time when you reduce your exposure to equities? Do you look at government paper? Do you look at debt? Do you look at commodities? What do you do?
So if you really note the four major factors on the global and the local macros, the global macros, as we just discussed, has turned little more uncertain. And in terms of local macros also, they are looking little more vulnerable than they used to be a couple of years ago. And given these two conditions, you put in an election calendar year which is extremely busy, with both state elections coming up later this year and then the general election next year. So definitely it's the consumption side and the less volatile and less beta oriented segments and sectors where we are more positive on.
Get a bit sector specific.
And in terms of equity allocation as well, I must say that the rates itself is on a firm side, they are on the rising side. So it's a tough call to be both on the lower duration side and then keeping on the equity side. We are positive on equities. We do see 15 to 20% earnings growth rate coming for the next 2 years as well. So we do remain positive on equities, but our sectoral allocations have changed a little, which is more focused on the consumption, more focused on the domestic side.
Okay, Alok, I just wanted to talk to you a bit sector specific, given that you are overall positive on the equity market. BFSI space is one hot favorite sector for several investors on the street, and you're also preferring private sector banks. At a time when a lot of people on the street are going for NBFCs, and they want to stay away from the entire banking space, whether it's PSBs or whether it's private space. Tell us what makes you upbeat on private banks vis-a-vis, say, NBFCs or PSBs?
So if you really note it down, the NBFCs, they have their funding side is from the market borrowings. And in case of banks, a large portion comes from the CASA, which is the low cost deposit. When the interest rates are lesser and they are falling, in such a case, that competitive advantage is not much there with the banks. But if we are in a different environment now, wherein the interest rates are rising, and hence low cost deposits makes your overall cost of funding lower, and hence our competitive advantages are higher. So that's what makes us prefer banks over NBFCs. But within the banks, again, there's a age-old debate between the private banks and PSU banks. We continue to prefer private sector banks. Yes, we do understand they are trading above 10-year average valuations, whereas PSU banks have been cheaper. On a 1-year forward basis, probably they are trading at less than 1-time book value. But we do see a better efficiency in terms of carrying the business, better efficiency in terms of asset quality, and better efficiency in terms of return ratios in case of private sector banks. So banks over NBFCs, private sector banks over PSU banks, and more of preference for private retail sector retail lenders rather than corporate lenders.
Thanks for giving us that clarity. Also, a very closely linked theme to the banking space is, of course, the consumption theme. So, given the fact that you are bullish on retail lenders, does that imply that you're betting on consumption as a theme as well? And what's the kind of sub-sectors within the consumption bracket are you looking at?
Yes, we are extremely positive on consumption, and India, in fact, the structural story about India is about demographics, and wherein consumption is likely to benefit even further. India as a country, we are in the zone of $1,900 to $2,000 kind of a per capita income, and usually historically for various countries this has proven to be the inflection point. So we do expect consumption to remain robust. It has been robust over the past. We do expect it to remain robust over the future as well. Investing in private sector retail lenders is also indirectly playing through the consumption. But within the consumption, we are positive both on the FMCG and discretionary, although our liking is more for the discretionary side. And within discretionary, be it the white goods segment or be it the auto segment, four-wheelers, they remain our top picks.
Okay, so that's the top picks that's coming in from DHFL Pramika Asset, saying there is a sectoral rejig given the global volatility plus the fact it's election year back home. Thanks a lot for joining us. Always a pleasure chatting with you.